The most common questions traders ask when they're using the MT4 platform is what a margin call is, what a stop out is, and how this is calculated in the platform using their open exposure with respect to leverage, balance, etc. During this video, we will take you through these different metrics for measuring your margin and how much you're using in terms of free margin against what's allowed for the platform. So it's important to note first the terminologies that are used when you're trading. Firstly, you have a margin call. Now, a margin call is the percentage that the MT4 has inputted as an automated amount that stops you from placing any more trades given the fact that you've reached full potential for your margin call and you have no more exposure left to place or no more leverage to trade a certain lot size in the market given your current balance. We'll take you through a few examples to show you how that works. In addition to a margin call, you have a stop out level. Now, stop out levels come after the margin call, and that is when the MT4 trading platform automatically stops your trades out given you've reached a certain percentage level, and this acts as kind of a barrier of protection for your account, preventing you from going into a negative balance, which is possible during high volatile market moves or weekend moves, perhaps when there's not a price there to take you out at your requested level. Just talking you through the two price levels now. So a lot of brokers have this commonly set at two respective levels. So you have your stop out at 50% and your margin call at 75%. This is 50% and 75% margin level percentage of your account with respect to both your equity and current margin that you're using. So let's take you through an example to make this more clear. So if you are following this video, try and get a pen and paper out and note down some of these formulas. Keep them on your trading screen when you are trading. Very interesting, or very useful rather, to understand how the dynamics of these calculations work and how you can use them for your risk management and trading plan strategy moving forward with your trade. So firstly, we'll take you through the different metrics that you see on your MT4 platform. The first one being balance. Now, of course, your balance is a subject of your initial deposit amount. That's pretty clear. The next one next to that, you'll see equity level. And your equity level is a function of your open positions and the profit or loss on those trades minus your balance. So that's your floating loss minus your balance. Or rather, apologies, your balance minus your floating loss. And that will equal your equity. So just again, your balance, looking from left to right, balance, equity, your equity being your balance minus your open positions, giving you your equity. So if you were to close out all of those trades at that particular time, your equity would then transform into your balance. So your equity gives you a reading of your open P&L at any particular time. Those two are pretty clear. Where it gets interesting is working out the following metrics. Firstly, your margin. So your margin is a function of the leverage that you have that you're trading with, as well as the notional volume that you are trading on a particular trade size. So we have an example here where we have an account balance of $1,000. If you can see it there, it's $1,000, and we're in a trade 3 lots long euro dollar. We're currently in a loss. We'll get into all of that during this example and show you how that affects your margin. So let me take you through what type of margin you're using for this 3-lot trade on your account. Now, in this example, the leverage that you have is 400. Apologies. 400 to 1. So that's the leverage on the account. So margin is calculated by the following formula. you have your notional trade size times the value of your trade that you're trading. So in this case, it's the euro US dollar. And just for argument's sake, it's currently trading at 1.12345. And then this figure is divided by the leverage on your account. And that will give you the margin used for that particular trade. So let's break this down. Notional on a 3-lot trade would be 300,000. Remember, for every one lot equals 100,000. 300,000 times 1.12345 divided by 400. And this figure will give you your margin. We'll just quickly calculate this. So by calculating the margin, that figure comes to 842.58. So this figure you'll see in your MT4 trading platform next to your equity figure, balance equity, and then the margin. So this is the margin you're using on that particular trade. Remember, you have $1,000 in your account, you're trading with 3 lots, you have 400 to 1 leverage, you're trading euro dollar 3 lots long. This is how you calculate your margin. We'll take you through that example just once again. Margin calculated by multiplying your notional volume, which would be in lots, times the value of the trade that you're trading. So it could be euro dollar, pound dollar, dollar yen, dollar CAD, any particular FX pair, and you divide that by the leverage you have on your account. Once you get that figure, you will then be able to calculate free margin and margin level percentage. So this is of course automatically calculated on the MT4 platform. This is how the formulas are derived. So let's take you through free margin now. So free margin is an important figure for you to understand for how much margin you have free in your account. So it's very simple. It's just a matter of minusing your equity against your margin. So if your equity is 400 and you're minusing that with the margin that you're using on the trade, which is 842, you're currently in a negative margin being used. So your free margin figure will represent a negative figure of minus 44258. So again, that's your equity minus your margin. We'll just put that here. So if you've ever wondered why you're in a negative free margin territory, that means you can't place any more trades, and you're probably running very close to a stop out level. So your equity minus your margin would give you the reasoning behind that figure. Now let's run into the most important one, which is your margin level percentage, to show you how far you are from getting a margin call if you've already got one, or how far you're away from a stop out level. So we'll just call it margin percentage in this example. Taking our current example, the formula derived to find this is your equity divided by your margin. So your equity being, in this example, $400, and your margin being 842.58. So just calculate this. So that's 46.91%. And that is your margin percentage. So it shows you that, look, you're really running very low on margin. You're probably almost very close to stop out, or if not already being stopped out at this price level you're at the moment. So its margin percentage is significant in finding out where you are in terms of your stop loss or your margin call level, and it's very important that you understand this metric, how it works, so you can begin to risk manage a bit better, understanding what available lot sizes you have in your arsenal to fall within your risk management plan, within your trading strategy, within your general trading plan, and manage your margin calls appropriately. So that is basically how we calculate those formulas. We've been through balance, we've been through equity, we've been through margin, free margin, and your margin level percentage. I do hope you've enjoyed this video, found it useful. We will be posting the formulas in the description as well below for you to take note of. Do let us know if you have any questions about this. If you want to know our stop out and margin call levels, do also email us and we will be in touch. Trade safe, risk manage appropriately, and all the best.